Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, you want to be a multifamily investor, well, this is the YouTube channel and podcast that we really created just for you. We're covering all of the latest research reports, kind of data points, original opinions, and articles revolving the multifamily industry, the housing market, and the general macroeconomy as a whole. Trying to help you make some really smart investing decisions and helping us make some good decisions as well. Today, we've got reports on RealPage, Apartment List, Redfin, and Yardi Matrix, and we're going to be taking a look at what are some of the more stable markets that are out there in terms of multifamily investing, which markets have performed incredibly well during previous recessions, economic downturns, and are those markets performing well in the softness that we're seeing throughout the economy, including the rental market. Again, I'll give you a hint. It starts with an Indy and ends with Annapolis. Let's get into the report. All right, welcome back to the report. Joined again by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, got a great set of reports to go over today. One thing that's certain, if it wasn't certain the past few weeks, if maybe you've missed the last few episodes of the Gray Report, is that we have entered into a period of softness. Yeah. And we're seeing negative absorption for the multifamily market. Mm-hmm. Not too surprising. Looking at the general economy as well, we're seeing softness kind of throughout. And after, a good 18 months plus of incredible record-setting growth, I mean, we've had almost 4 to 5 years of rent growth just in the past, year or so. Yeah. So this isn't too surprising of everything that is going on, but it's certainly a different story than we were talking about a couple months ago. Mm-hmm. And seasonality certainly is a factor. We're going into the winter months, but this started earlier than is typically seen. And a lot of this is just economic uncertainty. Yeah. So I think that's something that we need to highlight. And you no longer take a shotgun approach to multifamily investing of the markets are going up everywhere. Different markets performing differently. And it's time to be really careful and be, very acute on the conclusions that you're making and where you're investing. Yep. Because one thing that's been consistent that I've heard from housing experts, people investing in apartments and not, people who don't have any skin in the game, is that the fundamentals for multifamily housing are some of the strongest they've ever been. But it's a challenge right now to buy the assets. And there's so many moving pieces. People are wondering, are prices going to be lower next year? And should I wait till next year? Of course, you've had people sitting on the sidelines for years and decades of saying they're waiting for the right opportunity to get into the market to buy, and they've just been missing out. Is the broken clock? Is it going to be right? This time around.
One day my prince will come.
One day will be a great time to buy. Yeah. I'm bad at timing markets, but I'd rather just be really safe and find ways to navigate and mitigate risk. But it's a good question. Where do we go? Where are those risks? Because the risks are different than they were 6 months ago, 18 months ago, and certainly two years ago.
Yeah. If you're doing short-term investments anyways, that's such an anxiety-ridden life.
Yeah, exactly.
And so that's at least one of the big benefits of multifamily is that it is over these long periods where maybe timing, unless you really get it wrong and are exactly at the wrong point on the entrance and the exit, it's hard to really mistime it. And maybe, you can rely a little bit more on the fundamentals.
Yeah, I think this is not just for real estate investing right now. I think this is just investing in general, where you're seeing this from, asset managers, again, across asset classes, is that investments with some duration are a lot more palatable right now than something that's got to happen within the next year or so, especially when you're doing these types of transactions like with an apartment community or other type of commercial real estate. And when you're looking at, financing of whether it's a short, medium, or longer term, and we just don't know what the situation is going to be like in a year or two. Mm-hmm. And I think that many investors who typically real estate is a long-term hold, but you can make more money theoretically, with shorter term holds. The best example is that on average, over a 5-year hold period, you're typically going to double your money. Over a 10-year hold period, often you can 3 times your money. Well, obviously, if you double your money every 5 years, I'd rather get a 4x over 10 rather than a 3x.
Yeah.
And so it's that velocity of transactions. So, and that can be very enticing to whether that's a sponsor or just a limited partner investor. But that higher level of return is pretty well almost directly correlated to the level of risk.
Yeah.
And it involves timing things. And right now, it's what are the economic conditions going to look like in 2 years? Mm-hmm. I'm of the opinion that they're probably going to look a lot better. At least we're going to have more certainty than we have right now. Because if we're in a recession, we're getting ready to go into a recession. Typically they don't last more than 18 months or so. Typically they last about a year, sometimes less. But who knows? Who knows where financing rates, where cap rates are going to be? To then have to sell or refinance in those uncertain conditions. Now that being said, I'm much more confident that in 5, 7, and 10 years that the value of the assets that we'd be purchasing today, even if we're buying at the top, they're going to be much higher. Mm-hmm. And so the next couple of years, while they still matter, you're not forced to do anything, and you can let time and inflation and natural forces, and then just the lack of supply of real estate in general, especially residential real estate, really work for you. In addition to any value add in any appreciation you're going to force through your business plan.
Yeah, I think that's it's really important to remember that we've got long-term horizons, because for the last 3 weeks or maybe 2 months or so, we've been really coming to terms with a little bit different fundamentals. As much as the fundamentals are really still strong, really still robust, they're not as perfect as they were maybe in like March, or in the summer of this year. Things have kind of started to peter out, and we've been coming to terms. We've been figuring it out for the past 3 weeks. Yeah. We've been really repeating kind of the same ideas, so we have a good handle on it. And I know 3 weeks isn't that hard. It's too short to solve all the housing crisis, but it is still notable that the same answers keep coming up, and unfortunately, it's like also the same wrong answers keep coming up. So hopefully we can sort everyone through that.
Well, there's a lot of opinions, and rents are at the kind of closer to the front page than they typically are. And the repeated, the rent's too damn high. Well, sure, everything is too high, and high relative to what? And we're really talking about, and this is what we were discussing right before the show. Really talking about symptoms here, not really talking about core fundamental problems. And so that's what we wanted to get into today. Like, what are the broader problems, but then also maybe let's look short term also what's going on right now. Yeah. Because I think everyone got used to record absorption and record rent growth, and occupancies are so tight and they're so tight. Now that has changed. And so your playbook has to change as well. And I think certainly over the next year, it's going to be less. It's really going to be focused on operations and how you can execute and how can you retain your residents. How can you deliver them the level of service and value that's going to make them want to continue to stay, to renew, and accept whatever type of increase that you're going to have to pass through, because payrolls are going up, utilities are going up, property taxes are going up. Just about every expense line item is going up. And at similar rates of rent increases, some far more than rent increases. I mean, utilities are really blowing out in many cases, and payroll. I mean, we're in the middle of a labor shortage. We're at the lowest unemployment rate nationally and in many markets that we've seen in 40 years, and we just don't have the workforce to come in and fill these roles, and so you have to pay up. I mean, we're going through and looking at budgets for next year, and we're going to be paying people a lot more, because to us it's worth it to have the right people in the right place. The one thing that will ensure that a business plan can be executed, or the chance of success, I say, goes up quite a bit, is if you've got the right people on site. If you've got the wrong person on site, you can have the best business plan in the world, but like the boots on the ground haven't bought into it, and they're not going to fulfill that plan, it's not going to work. It's just going to stall. The one thing I've seen turn a property around is not deciding what different floor to put in, or some cosmetic change. It's all a community event. It can help maybe, but it's always is the right person in the right position. And that's the only thing that's going to really change something. And so if you don't have insight and visibility into your operations and you're flying blind, you're rolling the dice over the next year or so. Because I think really it's the simple blocking and tackling, getting your expenses under control, finding efficiencies, and just making your community like a place where people want to be and live, from the employees and to the residents.
I was thinking that sounds like a lot of work.
It is a lot.
It means you can't set it and forget it. That's the flip side of it. It's like, there is a passive investor, there's a way to passively invest, but if you are an operator, you can't just let things coast. Maybe it was working last year.
Yeah, no, in the past couple of years that largely did work. And it continues to amaze me when we go and look at properties or we're taking a property over, how that kind of set it and forget it, or just out of sight, out of mind.
Yeah.
Like that is prevalent throughout the industry. It's not every operator, but it's a lot more than you would think. Yeah. And it's amazing to me. We're talking about multi-million-dollar real estate projects, typically tens of millions of dollars. And it's like, you're just asleep at the wheel.
Or like spending, or like, chasing after pennies when the dollar, whatever that metaphor is, doing a cheap fix. Doing like a cheap fix that is going to kind of screw you on the long term, or really just not being aware and constantly doing the work to figure out what the right solution is to problems big and small.
So I think, from a active investor, from a GP standpoint, putting these deals together, really want to make sure that you are on top of your asset management and property management shops, that you do have full visibility into your assets, and as a limited partner, because that's not what you're signing up for. That's not your role or responsibility. The pressure is to choose the right operators that have those systems in place, and it's not their first time figuring this out. They've read a couple books and they've gone to the boot camp, and they're going to outsource everything. And they're a one-man band, or it's it's a team of people all across the country. That's all their first deal. Again, not that can't work, and that's a great way to get into the business and co-GPs, and I'm all about it. But purely talking about risk management from an LP's perspective, you want a team that has the operational chops and capacity to navigate through a complicated environment, because if you just let your third-party property manager do kind of whatever, they're not going to be they don't necessarily be fully focused on it. And they may think that they are, but again, there can be that disconnect, and so you got to be on top of it. Let's get into this first report, Matt. This is kind of all we're talking about from RealPage. I'm really glad that we included this, because we were both following the same LinkedIn conversation that Jay Parsons was having with a reporter, and
he's a great follow, by the way.
He is
him, and along with Carl Whitaker and the RealPage team really keep me informed.
Absolutely. We don't have the LinkedIn post here pulled up, but maybe
I hit it because it's just too spicy.
Yeah, it's too spicy. But long story short, Jay Parsons has been kind of repeatedly talking about some of the fundamentals, in that it's not that rents are necessarily too high. I mean, the incomes are, we'll go through a whole list, but there's pushback from people looking at things very simply and just saying, just the rent's too high. That's the problem.
Yeah. Well, and the post was from a reporter who cited a recent RealPage report from last week, and I'm going to quote this reporter in full because I think it provides pretty good emotional buildup, at least.
Yeah. Let's do it.
She said, "This one caused a bit of a head scratch. I would get it if the reason was sky-high rents, but the report claims it's not. That renters are in a good position financially and they are still making timely payments. They claim it's consumer confidence, that people don't want to branch out on their own and get their own apartment because they're concerned about finances. So maybe they're staying in roommate situations or still at home. Sorry, RealPage, but I still think it's high rent."
Yeah, and what is her focus of what does she
She's
cover?
She's a climate and real estate reporter.
Climate and real estate.
So Jake Parsons then commented very diplomatically. He said, this reporter, "You are great. I'm a big fan, but facts are number one, rent to income ratio stable. Number two, incomes are up. Number three, rent collections are up. And number four, there's no shift in demand to cheaper rentals." Jay Parsons again was very nice in responding to a reporter who disagreed with his article, but I was still a little bit riled up, so I responded to Jay Parsons.
It's facts versus feelings.
Yeah, and I said, well, given that landlords actively change rents in response to apartment demand, am I wrong in thinking that focusing on rents is kind of downstream of the real drivers of apartment demand? It's a bit like reading a report on flooding and saying, dam maintenance, rainfall patterns? No, the real problem here is all this water.
Yeah. Yeah.
I got 0 likes on that comment, but I still think it's it's a description of a symptom. It's not really getting at the cause of the problems. Like, we kind of understand, like, yes, that people are having a problem with rents, but you see that in other ways, and there's other ways to talk about that, and it does seem a little bit like a circular logic.
Well, and rents are high compared to what?
Yeah.
Certainly not mortgage. What you'd pay on a mortgage today. Compared to most other costs, buying a used car or anything else. And again, it's not the price for the used truck is so high because the price of the truck is so high. There's factors, supply chains, whatever it may be. A lot of the criticism I find on the rent being too high is from people who basically they don't believe that individuals or companies should own real estate to rent out to people, that housing is a fundamental human right. It should be free, and really have no true belief in property rights. And they don't necessarily want to say that up front. In the reporter that's covering climate and real estate, I guarantee that she has similar opinions kind of throughout the board on how the economy should be run, and doesn't believe in property rights. And sees landlords as parasites and leeches on society that provide zero value. And so she doesn't want to say that because she'll get called out for just not believing some
but it also could. What it also is in a little bit more charitably, rather than going like full commie.
Well, I'm just saying, like, that's where that comes from.
Yeah. Like, I think that's definitely like along the lines, and it's assuming that rent growth is a series of individual decisions made by people who should know better. Who are this is just a bunch of landlords deciding that they want to raise rents, and then you extrapolate that out. Yeah, exactly. So there's no thought of maybe that their costs are, and I'm not trying to say let's cry for the landlords. They will always charge as much rent as they can, and tell people stop paying it. That's just what the market is. You charge as much for an apple as people are.
A market. It is a market. We have a market. We have sort of a market-based economy, and that housing there's market rate housing and there's affordable housing. We're talking about market rate housing, and there's a bid and there's an ask and there's a market.
Yep.
So that's the system of how we as a society in most of the world has decided to allocate resources.
Yeah.
And if you disagree with that economic construct, well, yeah, you're going to have a lot of other problems. I'd rather you not be veiled and say, well, just the rents are high and landlords are greedy. Just say that you don't believe in property rights and we shouldn't have landlords, because we're not having a real conversation.
Maybe we should not have landlords, but that's going to take a whole lot longer to build that whole system from scratch.
Okay, what's the system to allocate the housing resources? We tried that in the 70s, not like the whole scale, but I mean the federal government was incredibly involved in building projects and providing housing for everybody. It was a complete disaster. I mean, just central planning is not always the best avenue to allocate resources through a complex and diverse society in complicated systems.
Yeah, and even just to boil it down to my single landlord making, if it is based on this idea that it's a single landlord, that's raising the rents that people can't pay, they have to have somewhere to live. But then I always think of it as, what about the next guy that wants to buy that apartment too, or that wants to rent it? I'll rent it for $1,500. I know that the next person won't rent it for $1,400, but if there's a guy that it's going to rent it for $1,500, then why not? Like, he needs that apartment. He's willing to spend more on it. And so that's what's driving it, is people are actually paying those ever increasing prices. Yeah. Now, the minute they stop paying, and they will, then rents go down. Yeah. There are software that does this too, and it's also not like these landlords are cruelly turning up the dials on their software either. Like, whether it's a person deciding it or a software deciding it, when people are unable to pay, they do get automatically ticked down. Like that's just how it works. That's how.
Well, and the reason why people are revenue management and LRO and that type of software is because the human element, it inclines to not raise rents as much as they should. In fact, because you're saying, well, they're a good resident, we don't want to increase their rent, or property manager will say that seems too much of an increase based on where our rents were, but not having true visibility into the market of saying, well, no, everyone else is charging $300 more than you. We can, if this is $100 increase, is still significantly below market. It's that human element that actually I think is a limiter and adds like resistance to rent growth. Often, not always. That's why people use those systems. So, well, I want to just pop into this real page article in more detail where I think this is good stuff revolving around it. But I want to just like hit his list because
totally,
our rent collections weakening. There's going to be a lot of not yets. Just a spoiler.
and especially for this rent collections, it was one of the more interesting charts that I've seen. Rent collections are at a lower level than they were pre-pandemic. They are about a percentage point, it seems like, below what the pre-pandemic average. Now, this is as measured by RealPage, but I don't know. It's not like catastrophic, but we are hovering around 95 or 96, and pre-pandemic it was around 96 or 97. So that's just something to keep in mind. But there has been no near-term decline in the rent collection rates, especially there has not been one that's correlated with the rise in rents.
Yeah. Is there a flight to affordability? I think this is really interesting because if his point in his LinkedIn post, and he's talking about it here as well, Jay Parsons, is that if the rent was too high, there are other options. There are cheaper options. You go from Class A to Class B to Class C. But we're not seeing that shift downward, which means that residents actually can afford the rent in many cases. But again, this is a not yet because I think there's a good chance that we may see that. But with unemployment, again, at like essentially a 40-year low, and we're seeing wages increase, we're just not seeing this flight to affordability yet, which I think, contrasts to, I think, what one might think just anecdotally of like things are expensive, looking for things that are cheaper. But I think people are prioritizing housing from the pandemic, even though we're returning to work in many cases.
Class A, the occupancy is about the same as Class C. Class B is took a little bit more of a hit, but even there's been a little bit of confounding information that like there's a Yardi report that we'll talk about that shows that Class C is doing a slightly better, but what we have seen really is that there seems to be a little bit of a wall in demand, or I'm sorry, a wall in rent growth for Class C properties. That may hold true, but then again, like they're pretty much like very similar. I saw there's a recent Berkadia report that talks about how Class A is doing really well. And then on the other hand, like I mentioned, this Yardi Matrix report that sees a little bit of the reverse, but it's just ever so slightly different. Yeah. So it's not like one is pouring into the other.
Yeah. Number 3, are renter incomes stagnating? I mean, I think this has been brought up so many times, just like, the incomes just aren't keeping up with the rent, and incomes aren't keeping up with the rent, which I would think, again, from anecdotes and even looking at some data, like, okay, that makes sense. But when you actually look at the people that are signing leases, incomes are actually rising quite a bit, kind of right along with rents, and even outpacing inflation, which is one of the reasons why inflation is still ticking up and hasn't gone away. Is because we still have a labor shortage. We don't have enough people, and a lot of the baby boomers have retired, and then the millennials and Gen X's have taken their positions, are getting paid more. It's leaving a gap for the lower skills segment, and you have to pay up because a lot of those are positions that, they may be lower skilled, but they're very necessary for the economy, and you can't go without them being done. So I think we're going to continue seeing wage growth.
Wage growth at 11.6% for the new lease signers that RealPage has recorded here. And it is about a percentage point or two, depending on what report you're getting. It is outpacing rent growth. And so, that's it.
So again, the rent's too damn high. Well, relative to what?
Yeah.
So let's talk about their theory, which I think this makes a lot of sense. Here's our theory. This is a quote: "Inflation is contributing to weakened consumer confidence and heightened uncertainty. When people are unsure about the economic outlook and their personal finance security, human nature is to go into a wait and see mode." We see this not only in the rental demand numbers, but also in the anemic for sale housing numbers. I think that makes a lot of sense. I think just that people are frozen for making major decisions right now when it's like, everyone and their mother is saying, like, we're either in a recession, we're going into a recession. The IMF this week said, global recession is right around the corner. We could be in a recession right now. Just a recession with crazy low unemployment, which is better than one with high unemployment. But I think it confounds some of the those on top.
And these answers here are circling it are the answers that we've talked about for 3 weeks or 2 months or whatever. It is inflation, uncertainty, low household formation, this wait and see mode. People are regrouping rather than splitting off and kind of forging their own household. And the idea that you said last week, we're maybe in 2021 we borrowed a little bit from this year in terms of apartment demand absorption. Maybe they decided last year that they were going to strike out on their own and rent a new apartment, whereas this year, well, they did that last year, so they're not gonna they're not gonna add to that.
And the potential upside, and I think this is a big if, depending on what happens, is that at some point people will just need to make some of those decisions, and they're going to have to move. They're going to want to look for a new place, and so we're going to see some of that demand come back in 2023, probably in March, April, May, maybe even earlier than we typically see it. But I think that's a big unknown still at this point. Yeah,
because as much as we saw that increase in absorption goes up and then maybe the absorption goes down, well, that's going to bounce back up maybe a little slightly, but usually you get that spike up, the spike down, and then a little, and then then that evens out like that. But
we shall see.
That's too much relying on the reversion to the mean, maybe.
Well, usually there's
when in doubt.
Exactly. When in doubt. All right, let's go to this Yardi Matrix National Multifamily Report. And again, we're just going to be kind of reiterating, getting into some detail on what we've been talking about of weakened demand in the apartment market nationwide. But I want to highlight some of these markets that I think have some really bright spots and are proven time and time again to be very resilient during times of economic uncertainty. But some of the top markets that are the most popular to invest in, there can be the most volatile. I'm just thinking of a lot of the Sunbelt markets that people love to invest in because of the migration trends, which make a lot of sense, but has a lot of volatility to the mix. An example, let's use Las Vegas or Phoenix as an example today, but also back in the Great Financial Crisis. You were 100% correct if you were investing in Phoenix back in 2006 or Las Vegas in 2006, looking at long-term population growth and long-term trends. If you had set up your investment to hold long-term, you made an incredible amount of money. However, that incredible volatility and growth is met with equal amounts of upside and downside, and so it rises very high and then it drops suddenly and in a violent way at times. So we saw it in Phoenix, we saw it in Las Vegas, we saw it in many Sunbelt markets, especially markets in Florida, Miami, Tampa. Some of these, again, high growth markets that have looked great and will probably be great 10 years from now. But right now, there's emergence of a potential, not crash, but major declines in some of these markets. And then there's some markets that kind of just keep chugging along at not necessarily low growth rates, but like pretty moderate. And, they just kind of they're just right there, they're in the middle of the pack sometimes, and then everything drops in times of economic uncertainty.
And we saw this.
And they move to the top.
We saw this in 2020 for sure.
It
was brief. I will say, it wasn't like, I think that the anxiety of 2020 was more like shock,
Yeah.
And this is more like dread.
Yeah, exactly.
But just to get the top line numbers for your line. So month over month rent growth is at 0.0%. So completely stable. But you know,
Flat, yeah.
not the breakneck growth, but also not the slight decline that we saw in a few other reports from last month. But they also have year-over-year rent growth is at 9.4%, which is actually a little bit on the high end compared to some of the other reports. But as much as it is on the high end, it is still lower than the lower than the income growth that we just saw from the RealPage report. So that's pretty great. They also, I did comment earlier when talking about that RealPage thing, that Class C rent growth seems to be a little bit higher, whether it's year over year or month over month. But the more interesting thing that I thought about for this report was they almost as if they knew what we'd be talking about today. They have added 2 new sections to their report: a section on renewal percentages and renewal rent growth, as well as a section on rent to income ratios. Now, skipping to rent to income ratios, they just have a kind of a simple list here, but it really is very interesting. No national average here. They have 30 markets sorted from highest rent to income ratio to lowest rent to income ratio. And before we even get into the list, I'm going to operate under the assumption that a higher rent to income ratio means that this particular market has a more expensive apartment market, and a lower one, maybe it's more, the higher one, maybe it's more competitive, maybe has more amenities. But the key to keep in mind here is that this is a rent to income. So it factors in higher wages. It's a ratio such that you might be making a lot more, but then your income, your rent is raising at the same way. So we're not talking about necessarily like cost of living like discretely. We're talking about how much of your income is taken up by rent in each of these places. So you don't always see the same kind of high flyers in this list that you do in other lists.
Yeah, and just remind everyone, like 30% rent to income ratio is typically the test that most use to qualify a resident. You have to be making 3 times your monthly rent as typically gross income, not even kind of after tax. And New York City, I guess not surprisingly, although it was a good point, people are making more money in New York City, but still looking at just the ratio, they're paying about just under 37%.
Now, and
these are renter by necessity units. Now, for lifestyle units, a little bit closer to 30 at 31.
Yeah, so their all units average is 33.9, so almost like 34%. Now, I do want to note, like, these are almost like 10% more than what RealPage stated their average in August or July earlier this year, at least. And I don't think things have changed that much. That was like 23%. So I'm not sure. Yeah, I'm not sure where these are
major. Do they have a national average? Because I think
they did not have a national, not in this.
Because if
report.
they took a national average, but this list is mostly just the major metros. And if they did a national average, it probably would bring that down. Because when you look at some of these smaller metros, first, we'll look at the tops. A lot of the larger metros, some of the ones you may assume: New York, Orange County, DC, Sacramento, LA, San Francisco, Inland Empire, Baltimore. And then, getting into some other major markets. But down at the bottom, again, this is where I would think would be an indication of, all right, we might actually have some room to grow here.
Yeah.
And it is affordable. That's the reason why people move to some of these markets. At the bottom of the list, the most affordable on this list of major metros is Kansas City at 24.2%. Followed by Indianapolis at 25.9%, and that's overall. Surprisingly, though, and I took this surprisingly, and maybe it's the income, high income is the answer to why we were surprised. But Austin, Texas, number 3 at 26.5 overall. And again, maybe it's like they were working for a tech company in LA and they moved to Austin and they're still working from home and they're making a ton of money on an LA salary, but Austin was a little bit cheaper.
Yeah, it's just how the trajectory of each of them go. I thought it was also interesting. Twin Cities, which has really been pummeled in the last 2 years, really recording, and you can see it. It is not doing great in terms of rent growth. It is like the middle of the pack when it comes to rent to income ratio. So very, very interesting. Not a clear cut. Rent growth does not always mean high rent to income ratio.
That is true. Let's just look really quick on just what some of the markets that are how they're doing in terms of rent growth. Because again, wanted to focus on some of the markets that you don't always hear about unless you're listening to the Gray Report and listening to us. But number one, year over year rent growth, all asset classes, is Miami. And not a big surprise there, because, and these are major metros, because again, it seemed like half of New York moved to Miami. And then Orlando, number two, followed by Nashville, followed by Tampa, Dallas. So that top five, that's not a big surprise. Again, Miami, Orlando, Nashville, Dallas, and Tampa. Guess what's number six, Matt? You're looking at the screen, as is everyone else, but and you know this, but it's Indianapolis. And again, people talk about, and I talk to institutional investors, and they'll be like, well, we just love talking to them about the Midwest, and they're like, well, yeah, there's some markets that are interesting, but we just really like the growth story. We really like the growth story of the Sun Belt. Like we're going for the rent growth because we will justify buying at a very low cap rate because we're chasing the growth. We're chasing the growth. I'm like, okay, yeah, I see how that can make sense. But what growth are you chasing relative to some much more stable markets?
Yeah.
Again, so go ahead, Matt.
And if you look at month over month, we got Kansas City as number 6.
Yeah.
So, whatever you slide, there are these, so it's not just Indianapolis, even though like reading these reports, I was like, man, Indianapolis looks really great. But no matter how you slice it, there are some opportunities in the Midwest, and it is rhyming a little bit with the beginning of the pandemic during these uncertain periods when these steadier markets start bubbling to the top. And guess what? When things go great, it's not like these steady markets in the Midwest go bad. They just continue at their steady rate.
Well, it was about 6 months ago when we started seeing some really strong increases. Indianapolis kind of dropped to like kind of the middle or the bottom half, because it was all year over year numbers and year over year growth. But what a lot of people forgot about is that very few markets, like Indianapolis, I think maybe like a Salt Lake City, and I think maybe Kansas City, they actually didn't see any rent declines during the pandemic.
Yeah.
Most markets, almost all markets saw rent declines during the pandemic during 2020. It was only a handful that didn't. And so when you're looking at year over year numbers, when you're comparing the growth from a positive 1 versus a negative 5, well, if you're growing, you have a lot more opportunity to grow just to get back at parity when you've had a decline. So you've really, over a 2-year period, you've had zero growth, but in a 1-year period, you've got 10%. Then in Indianapolis, over a 10-year period, or one of these other markets that didn't have declines, you're actually seeing really strong, multi-year growth overall. But the year over year is less because you didn't decline.
Yeah,
there's no base effect.
And even though we were steady, when rents went like gangbusters, we still went relatively gangbusters. Maybe just not like hyperventilatingly. High.
Well, in the suburbs, it was. I mean, it was very similar to the strongest Sunbelt metros.
Yeah, that's true.
And so when you look at the spread between what you're paying for, what you're paying for the cash flow, the cap rate on an acquisition, compared to the growth that you're going to see, I could see someone saying, well, yeah, you're going to get a high cap rate, but you're going to get low growth. So it'll cash flow, but you're not going to get a big swing because that growth is just going to be, low single digits. But if you can buy at a higher cap rate, so at a discount relative to the rest of the national market, but you're seeing high growth at the same time, it's a pretty good combination for strong cash flow, strong appreciation. The only argument against it would be, well, maybe you're not going to see as much cap rate compression in a market in the Midwest compared to the Sun Belt. Basically saying that like the trade is just going to continue to be crowded in the Sun Belt because that is the consensus trade. Yeah,
that's what I was going to say. It's like you're chasing something, you're probably running with a whole pack of other people that are chasing and kind of bidding up those prices.
Yeah, you're pressing the easy button, which is fine. And again, there's a lot of reasons to invest in the Sun Belt.
Yeah,
there's a ton. It's just that it's a big market out there, and there's a lot of really interesting opportunities if you've got the time to look a little bit closer.
I just want to say one thing really quick about the about the rent renewals that they have, because that was another.
I was happy they included those because they've been moving around a little bit.
And I want to track so now that they have this, and they have promised that they're going to do this every month. It'll be nice to have this kind of ballpark figure in my head, because I'm not sure. What is a typical renewal rate that you?
I mean, industry standard, kind of your basic is 50%.
Okay.
Historically, I mean that's what that's like your back in the napkin rule of thumb. Yeah. It's 50%. It's bumped up in the pandemic. I think we hit like 60% at some point, according to, I want to say, RealPage. Maybe it was Apartment List. So yeah, I agree. I'm glad that Yardi is tracking this.
Yeah. So just for quick numbers, national lease renewals increased 60 basis points to 59.1%. The first increase since February of this year. So they also have a list of markets, and so at the top this is ranked by year-over-year renewal rent growth. At the top is the Miami Metro with 20.8% year-over-year renewal rent growth. And at the bottom is San Francisco with 3.7 year-over-year renewal rent growth and a monthly lease renewal rate of 39.1%. That's the low-end outlier. That's like the biggest outlier in this whole chart is San Francisco, where nobody's renewing, very few are renewing, and those that do renew don't really have to pay that much more. But in the middle of the pack is Kansas City and Indianapolis, which have about a 10 and a 9% renewal rent growth respectively, and their monthly lease renewal rate for Kansas City is 66 and Indianapolis 61. It seems like the top end of the monthly lease renewal rate is around the 60s, maybe mid 60s is like the top end, and the low end is like around the mid 50s. So that's kind of, and they don't map perfectly. For instance, Kansas City is in the middle of the pack when it comes to year-over-year rent growth, but when it comes to their renewal rate, they're like the number 2 of these 30 markets listed.
And those are high renewal rates, and I think that leads to this conclusion we talked about earlier of just seeing less absorption and demand because people aren't moving around.
And I think that we kind of had a sense for this in the past years, and it is also a temporary thing, but we're still in the process of seeing renewals increase. The leases, like the growth of the new leases last year, is bleeding into the renewals, and that will kind of continue for the next year or so. Before things kind of peter out. Yeah,
exactly. Yeah, and there's just the difference between that market rate renewal for new leases and the actual renewal rates. Yep. I think we're going to continue to see that absorbed. Yep. I can see, and I'm already seeing, some moderation during right now because people are like, where's traffic going? People aren't coming in the door. Yeah. We're not getting applications signed, and we're going into winter. I think we're going to see some continued pullback through the winter months of people. I think concessions are going to go up. I think there's going to be some discounts. They're not going to be huge, but they're still going to be positive, year over year. Yeah. But I think we're going to see some of the things that were relatively common a couple of years ago. Jay and I were having a conversation earlier. It's like, well, people we forgot about doing specials because we haven't needed to do a special in the last year and a half. And it's like, well, okay, if we're sitting at 90% occupancy, we want to get it filled up going in the winter months when traffic we know is going to be low. So if it takes a little special and concession, we got to do what we have to do. I want to be careful with those, but
at least I think if this 60% number does represent a departure from the norm of 50%. If more people are renewing, then maybe it's a little bit of a cushion if the value of a renewal rate is increasing or that rent growth is increasing. Yeah. It's a little bit of tailwinds to kind of counterbalance.
For sure. Well, especially when renewal growth is higher than typical organic rent growth. Yeah. I mean, the way that it was done before the pandemic is renewals were like a nominal token increase. It's like your rent's going to go up $15 or $25. Like that was like very standard. Like we usually bump $25 on renewals. Like $50 would be a big renewal. $100 you would not typically see that unless you were like, you wanted them to move or they're so far below market, and then you get your rent increases on your new leases. But now, when you're looking at leases that are hundreds of dollars below where market is, you're seeing these renewals come out at higher rates, and especially as groups buy apartment communities, they buy real estate. They're looking at the rents being below market. In order to achieve those business plans, they got to get them up to market, and that oftentimes having the difficult conversations with residents of saying like, well, you're renting for $750. You've been a great long-term resident for the last 3 years. We want to keep you. Here's our market survey for the exact same type of unit elsewhere. You're looking at $1,250.
Well, and that's the reverse is like, and the reverse fear is, well, I don't want to raise those renewals too much because what if I can't get a new guy in there?
Yeah, because you're not seeing the traffic.
Yeah. So there is a balance. This is how the market works.
in a month, 2 months ago, the concern wasn't there because their traffic was there. So it's like, yeah, take it or we'll lease it because we've got a waiting list.
Yeah.
Like people are coming in by the dozens to sign up to lease apartments. But now without that, it's like, well, okay, your rent $750. Everywhere else in the market's $1,250. How about $850 or $900. Let's get you a little bit closer, but we want you to stay. And how can we get you to stay if you've been a good resident? We want you to stick around. We want to maintain a sense of community and not just because then all of a sudden you can find yourself with low occupancy. You're below
so there's
90%.
there's definitely a band, and that's what's negotiated. And so it's not like by fiat these decisions get made. There's a lot of considerations, and dare I say human considerations as well.
I think there are, and then there's fair housing questions that you want to make sure you're on top of. But again, this comes back to the point that we were making earlier, Matt, is that like right now is not a time to be on autopilot. Yeah. Now is for the active investors, the GPs, the actual owners, not for the LPs. The LPs, your job is to pick the jockey, but for those owner operators, it's like time to get into the weeds and be tactical and being like, all right, how do we make the best out of this situation? It's spending the resources in the right ways, not overspending, but all right, well, how do we get traffic in the door? Maybe we need to do marketing a little bit different way. Maybe we need to think about specials. Maybe we need to think about renewals differently than we were thinking about 3 weeks ago. And if you're relying on a third-party property manager to figure all that out for you when they're managing a large portfolio of other people's properties, maybe they're on top of it. But sometimes you're just they're getting through, getting to the next thing. And unless you're like, we need to do this, X, Y, and Z, it's going to be 6 months from now, and you're like, well, we missed the opportunity. Because these things happen quick. Yeah. 2020, ended the second half of 2020, rents started increasing. First half of 2021, a lot of groups were just, they were just still in like idle mode, and they weren't tracking the market. But if you were tracking the market, you were subscribed to the Gray Report, you were able to absorb and harvest just where the market was versus just sitting around and being like, well, I'll get my quarterly report and, things are going pretty well. And it's only a $50 million project. I don't need to spend too many hours a week on it, do I? There's a lot of people. A month. You know what? They did time it right, but the real sustainable thing over the long time period of a multifamily investment is going to be the work that you put into it and the decisions that you make and the attention that you pay to it. I definitely. Matt, the love you take is equal to the love you make. It is true again. He's got a point there. Let's talk about this apartment list report. We're talking about the suburbs now. We've talked about in the past. I think it's something to continue to discuss because it's not really a fad, and it started before the pandemic, just barely, but it started before the pandemic. It's the suburban rent boom, and that's where the growth is in general. I mean, it's not. I mean, the urban cores are sort of recovered, but not fully from the pandemic. They're not what they used to be, and people are moving to the suburbs. They want more space. People are getting married, or they're thinking about getting married, having kids, or thinking about having kids, or like the idea of it. And enough on the margins of people some of them are actually doing that, specifically millennials, we're moving the needle. And look at that. This is what the suburbs look like? In,
it's the stock photo Suburbs.
where do you okay, where,
it's definitely
Phoenix?
Arizona.
Yeah, okay.
That's what I think.
It could be somewhere. No, that's probably not California. Anyway, Matt, do you ever?
So
do you ever? Have you? I'm sorry. Have you ever watched the videos of the guys that use Google Earth and they
Yes.
like a quick picture and they have to geolocate
Yeah,
anywhere in the world?
I have. There was some
impressive
challenge the other day that was like that. Oh, no. There was some video I watched where it was a mystery box and you got a key out of this mystery box. And it was like, there is a car in this location. If you can find it, then you get the car.
Yeah. Oh, that's cool.
Yeah.
Well, that's like the was that a geocache?
I think it was something like that.
Okay.
It seemed like that.
Well,
like
this
you
is the
find
guys
the
that are
clues in
going
the picture
on,
and then
like it's on Google Earth.
Yeah.
And like it's like one image and they're like, well, this is the type of grass that only grows in Peru.
And they always get it right.
And like, yeah, well, at least the videos that you see,
Yeah,
it is
it's true. Yeah.
We digress.
Yeah. So just to kind of restart to reorient towards the suburbs.
Talking about the suburbs, and we identified.
Article got me thinking a little bit about the difference between a city and a suburb, and just to kind of skim through what I was thinking about, and which actually does reflect this idea that the suburbs are changing. I think that this is the underlying point. It's not like the clear overt point that they're making, which is that more people are going into the suburbs, but there's this undercurrent of a changing suburb and how suburbs are kind of becoming little cities in their own right. So depending on where you point the metropole, the outskirts are going to be different. So there is one way of defining it is it inside the MSA? Well, that's the city. Is it outside? It's a suburb. And another way is this historical definition I thought was kind of interesting is
the
like
MSA, the MSA is going to be huge though.
Yeah, I know. Well, you can define your MSA, so that's why it's also this is a joint Harvard Joint Center for Housing Studies report that I was pulling this from. But the next one is this, and they talk about the MSA rule. They say it's like very flexible. It's easy. You can work with it. You can define it how you want, whatever point you want to make. Next is this historical definition where if houses were built before 1940s, it's the city. If they were built from like 1950 to 1969, it's an inner ring suburb, and so there's like a historical progression that kind of fits but not really. And then the other thing that I think fits it maybe the best but still doesn't reflect everything is how much are you driving your car, how much people own single family homes, and there's a kind of continuum that is more or less I keep thinking of population density.
I was going to say that's what you were just saying, and you would think population density would be kind of a core piece of all of that.
Yeah.
It seems like the definition of pornography. I know it when I see it. But definitely, I think things can evolve and adapt, and we've seen suburbs. We've talked about in the Great Report in the past. I mean, we've seen certain suburbs that are little mini cities. Yeah. That doesn't mean they're not suburbs, but suburbs can be cities, and cities can be suburbs, and some cities aren't suburbs, and there's old... Yeah. I mean, just again, we focus on Indianapolis because that's where we were born and raised, and we both lived other places. But there's old suburbs that are in downtown Indianapolis. And the Lockerbie, Lockerbie Place was one of the first the first suburbs, and Woodruff Place, and those are like right next to downtown. They're single family homes, but they're definitely in the city. And
there are suburbs around the country. I don't think Carmel, Indiana is the only one that has transformed into this place of big yards and single family homes. And there are areas within, I'm just using Carmel, Indiana as an example. There's like a little downtown there. It fits all of these definitions of urban, and so it's like very dense. Regardless of how you define it, you run into these clear examples of how suburbs have changed.
Well, can we just find out just like a lot of subdivisions?
Yeah, I know.
Subdivisions.
I think population density should get you really a long way there, because population density will make a neighborhood more walkable, which is one of these kind of characteristics.
Do you have a cul-de-sac?
Yeah, exactly. Because like we said before, and this was like several months ago, it's hard to make something walkable. It's hard to make that city feel if you're walking past 50 yards versus walking past one building.
Matt, do you think there's going to be any kind of retracement back to the city? I think we've seen sort of a recovery, but there are, especially for younger people, there's an attractiveness to the city. There's a reason why people live in higher density locations. are the demographics just too strong for millennials wanting some more space, or is that appreciation for the social theater and the walkability and all that? Is that, have we lost that? Because the last decade or so was this like resurgence of the urban core of the city. Is that like gone? Is that old news or what?
Well, so I feel like, and this is what we're talking about, they're kind of, now this is very cliche, kind of bringing the city into the suburbs in creating these denser areas. There's all, I don't know if you've seen the movie Up, where the buildings come up around the little city. You're seeing that happen, maybe not in the city anymore, but you're seeing it in these outskirts communities where where there's not necessarily skyscrapers, but there's definitely multi-floor buildings coming up, big commercial areas, and people are walking around. So I think that there is going to be there is kind of urbanization still happening, maybe on the outskirts.
But let's just build in the suburbs.
Yeah, but I also think that there is that downtown apartments got hit, downtown offices really got hit, and it's hard. It's hard to see them not coming back. Yeah, and a lot of those companies are moving to the suburbs, and I don't know. I appreciate it all. Some people are like city, suburb, rural. I've lived in New York City, Manhattan, Brooklyn. I've lived born in suburbs of Indianapolis. Lived in a couple suburbs in Indy. Mm-hmm. Lived in Bloomington. I lived in sort of urban Indianapolis, and then I've also lived in very rural, on a farm as well. And it's all you make of it. It's all good. There's pros and cons, but it's fascinating. But one thing's for sure is that rent growth there's been some divergence depending on how far you are out. Yeah. And the further you are out, if you're in that path of progress, maybe you've had a lot more room to grow from. But it's the furthest away you are out from a city, the higher the rent growth has been, and it's pretty consistent. And the bigger the city, the stronger this effect has been. Interesting. Yeah. That's interesting. I keep thinking, and again, this is only for people that know Indianapolis, but it's you go from Carmel to what is it? Is it Whitestown? Yeah, and then exactly. And there's always another horizon. Yeah. No, exactly. It's following that path of progress. Whether that's up, 31, we followed that through, or it's through 69 and Fishers and Noblesville, and then up 65 now, it's Zionsville and then Lebanon, and then there's West Lafayette, there's Lafayette, West Lafayette, you can go Kokomo if you're up north, Kokomo going up 31. So those all going to kind of merge together. And you can do a lot of really good real estate investing just by following those paths of progress. And what are the things that are going to connect those nodes? And, looking at it almost like organically of what's going to grow, and it's through whether it used to be rivers, and it's usually linked to transportation. And so now we're using interstates, and we've got Chicago up here and Indianapolis to the south, and these cities in the middle that are growing because of the transportation, whether it's logistics, other types of jobs, and you can do pretty well just by tracking those paths of progress, and all you need is kind of Google Earth and go back in time to kind of see. Man, I get lost in just looking at that. That's really fun. It is fun. Well, man, if there's one thing that I think that we know is that there's a lot of uncertainty out there, but I think breaking this all down helps us, at least give us the information to help us form some opinions of where we're going to go. And again, I don't think we can make it's why the yield curve's inverted, right? We're more confident about 10 years from now than we are 2 years from now. And I think having some of this long-term perspective is always important. We've always looked at real estate investing from a long-term prospect. And I think the importance of that is more important now than ever. So I hope you continue to watch episodes of The Gray Report. Make sure you subscribe to the Gray Capital YouTube channel. You're checking us out in podcasts if you're on the go. We also have webinars of some upcoming multifamily investment opportunities from Gray Capital, only open to accredited investors. So if you want to hop on over to our website, graycapitalllc.com, you can learn more about those there. Learn more about the Gray Fund by just going to gray.fund. Schedule a meeting with one of the members of the team. Love to learn more about kind of what you're trying to accomplish in real estate. If Gray Capital can help facilitate some of those goals or not, or we can help point you in the right direction. But we'd love to hear from you. So again, looking forward to seeing you on the next episode of The Gray Report, and have a good rest of your week.